Hello and welcome to a quarterly update from Custodian REIT, the regional smaller property specialist. I'm Richard Shepherd-Cross, the investment manager, and with my colleague Ed Moore, we will take you through the most recent financial highlights, the investment strategy of Custodian REIT, and a little bit more detail besides. So firstly, over to you, Ed.
Thanks. So I'll kick off with some headline performance for the 12 months to March 22. Starting with dividends, Custodian operates as a true REIT. That means we seek to distribute the vast majority of our net rental income. And you can see from the numbers as our EPRA earnings per share have increased as rent collection rates have stabilised following the COVID-19 pandemic. We've been able to increase dividends per share accordingly from 5p to then 5.25p, and we now have a target dividend for FY23 5.5p. You can see on the left that we've had a NAV total return of 28.4%, comprising 5.8% of income and 22.6% capital growth. Richard will talk more about sector performance later on, but you'll probably be aware the majority of that capital growth has been seen in the industrial and logistics sector, albeit we've had some profitable opportunistic disposals during the year. But hopefully you'll take from this presentation that the focus of the manager's role with Custodian REIT is to maximise income for shareholders, because that's the element of total return that will deliver every time. Moving down, you'll see net gearing at 19.1%. So that's slightly below target of 25%, and that's largely been driven by valuation increases of £94 million, or about 16% that we've seen over the course of the year. Occupancy is 89.9%, although importantly, 37% of that vacancy is under offer to let, and around 30% of it is planned for refurbishment. And we'll talk a bit later on how the refurbishment programme that we have should be delivering valuation increases as well as having a positive impact on our ESG aspirations. You can see towards the bottom rental growth potential of 20%, so that's 10% on let and 20% including vacancy. So we believe that the portfolio is reversionary and there's still a significant amount of rental growth to come through that will support those increased valuations. And finally, we note the acquisition of Drum Income Plus REIT at the bottom. So that acquisition completed last year. It was done at over 20% discount to NAV. That delivered a £7 million uplift on completion, and we've seen that portfolio be very stable since acquisition. And it was important to note that we were able to achieve that market consolidation with a significant uplift for Custodian REIT shareholders, but still done at a price that was accretive to incoming Drum shareholders as well. I'll hand back to Richard.
Thanks, Ed. And just to go into a bit more detail on rental growth, you can see in the chart here the 12-month figures, which show very positive rental growth in the industrial and logistics sector, just under 11%. Office rents growing, and over the year, we were still suffering from the tail end of the COVID impact. But in the last 6 months, we've seen a turnaround. So retail warehouse rents moved to positive growth. High street retail moved to positive growth. And I think that would be a surprise to many. So it really feels as though in those sectors that did suffer, offices, retail, and customer-facing real estate that suffered through COVID, that those rents have bottomed out and we are returning to growth. Of course, growth that we've had is perhaps less interesting than growth that's still to come, because it's the growth that's still to come that's going to provide inflation protection and many people look to real estate as a hedge against inflation, but it's only a hedge if you see real rental growth. So we look at the industrial and logistics sector. This is the sector where we saw valuations grow 26.5% last year, but that's against a market average of 37%, extraordinary capital value growth in that sector. And I think the reason our portfolio lagged that market average, and let's face it, that's a good thing because it means there is greater capacity for growth from this point forwards, is because of our investment strategy. It's focusing on smaller regional properties, and I'll go into that in just a second, so hold that thought. But if we look at our average industrial rents, they are only £5.27 a square foot, and those rents are not high enough to bring forward new development in the market. Rents really need to be £6.50 a square foot to bring forward new development, and of course there's any new development that's going to add to supply. So we feel that there is continued rental growth potential in that sector. Office rents are growing in prime regional centres. It's been more difficult in business parks, but our focus has been in city centres of late. And retail warehouses, like I said, those rents are bottomed out. High street rents are bottomed out. So there's a very good case to argue that there is growth still to come through that will help provide that hedge against inflation. So to our investment strategy, the key differentiator for Custodian REIT is that we focus on smaller regional properties. And by smaller, we mean sub £10 million at the point of acquisition. We look for strong local economies, so we are not London and South East focused. We look for those strong micro markets across the UK, modern or fit for purpose buildings, and diversification. Diversification is an alternate way of looking at risk. And the income that is generated from the Custodian REIT portfolio comes from 160 properties and over 300 tenancies. And that, as we will, if you consider over the last 3 years that everyone's focus has been on thematic investment and particularly on logistics. But the recent news that Amazon are recording lower online sales and now believe that they have a surplus of space, having accounted for 25% of the leasing market in the logistics sector, gave those thematic logistics listed vehicles a real shock, and the share price was knocked back 20% last week on that breaking news. So perhaps now is the time to look at a diversified sector with a greater focus on income and with less volatility to bits of bad news, such as the Amazon news from last week. We believe in refurbishing our properties, so we're long-term holders, just in the same way that we all treat our own houses. You've got to keep the buildings up to modern specification if you want to maintain value. And Ed has touched on gearing already, target gearing of 25%. So why do we have a smaller property focus? The answers are that we get an enhanced yield. We get a marginal income return for being bothered to buy smaller lot size property. But also in doing that, we believe that we have a greater share of value in the underlying bricks and mortar. So we've got the residual value. And I suppose you can demonstrate that by recent examples of an office building that we are selling at the moment. We've owned it since the REIT was launched in 2014. It's been let to a firm of solicitors. We've enjoyed good income for the last 8 years, but their lease expires in a year's time, and we know they want to leave. What we've actually managed to achieve is a sale of the building with vacant possession to an owner-occupier who's paid a price some 20% ahead of the investment value. And that's that residual value point. These smaller properties are in demand both to lease and from owner occupiers, and that really helps support that residual value. More value in the bricks and mortar, really important. Yes, of course, there's value in lease contracts, but leases run out over time. But the underlying real estate is where you really want the largest share of value. Through diversification, through having smaller properties, we have more of them, and therefore we're spreading the risk and stabilizing the cash flow. And we are very income focused, and through those smaller properties, we get that marginal income, and that marginal income should drive outperformance over time. The great thing about income is it's forecastable, predictable, and the compound impact of a higher level of income, as I said, should lead to outperformance. If you take nothing away from this presentation, please remember this chart, because this is right at the heart of our strategy. And what it looks at is the marginal income return for owning smaller lot size property. And the chart shows in the dark blue line the average transaction yield, the net initial yield of properties traded in the market with a lot size of less than 10 million. And the light blue line is lot sizes of over 10 million. And you'll see that for the first 10 years of this chart, from 2000 to 2010, that was a pretty even and narrow margin of about 75 basis points. But from 2010 onwards, you've seen that huge divergence. So currently sitting at about 189 basis point margin. Normally, you would expect a margin like that to reflect high level of risk. But what changed in 2010? Did smaller lot size properties become higher risk, or larger lot size properties become lower risk? No, of course, there was no change in the risk profile. What we saw was a change in the demand and supply dynamics. So a larger number of investors pursued a larger lot size strategy. Overseas private equity, overseas sovereign wealth funds, UK institutions, and pension schemes, all focused on relatively prime, larger lots in a reasonably restricted supply, and the net effect of that was yield compression. And you can see that very clearly on the chart. And at the same time, people were moving away from a smaller lot size strategy because it's hard work. And people say you don't get enough bang for your buck in delivering on asset management for the same amount of work's involved. So we saw an increase in supply of the smaller lots and fewer people pursuing that strategy. So simply by being bothered to own the smaller lot sizes, we can deliver a yield pickup of certainly 150 basis points for taking no additional property risk. And you don't have to sacrifice tenant covenant, quality of location, or quality of building just because you're buying smaller lots. And that's the basis of our strategy, finding that marginal income for taking no additional risk. That's the alchemy of the Custodian REIT strategy. And let's look at that in real terms. Here we have 4 industrial buildings, industrial and logistics buildings in the Midlands. They all transacted last year. And on the left, the 2 smaller ones in Nottingham and Leicester, 3.9, 6.3 million. And on the right in Walsall and Thrapston, 30 and 102 million. And I suppose the numbers speak for themselves. What's important to note from these is none of these buildings are brand new. None of them are let for over 10 years. They're all let off similar rental levels, so somewhere between £5 and £5.70 a square foot. Yet the additional yield delivered from the smaller properties is, as you can see, on average about 150 basis points. So the question is, are you taking greater risk? Well, what is risk? Risk is risk of vacancy, risk of not seeing rental growth. So just consider those 2 points. The risk of vacancy in Thrapston is huge. It's £100 million asset. If the tenant decides to leave at the end of the lease, that's a very significant void in anybody's portfolio. By contrast with a smaller lot size strategy, you might have 20 properties that make up 100 million. So that risk of vacancy is vastly reduced. Yet you get a higher yield for taking that lower risk of vacancy. And then let's consider rental growth. Larger buildings are per square foot cheaper to build, and therefore they can afford, they can be let at lower rents. And ultimately, the driver of rental growth is governed by supply, and supply is governed by the ability to bring forward new development. But you can increase the supply of larger buildings more cheaply than you can of smaller buildings, because smaller buildings are more expensive to build, and therefore they command higher rents, and therefore the pressure for rental growth for the smaller units is greater, I would argue, than it is for larger ones. Yet you get a higher yield for having that better rental growth prospect. So the market feels out of kilter, and that's the market we operate in. We can find that mispricing by operating a smaller lot size strategy. We've talked about diversification, and you can see here how the portfolio is split between the different sectors and how that has changed over time. And it's been broadly consistent. We've always been an industrial logistics heavy fund, but you'll see we have decreased our exposure from somewhere around 17, 18, as much as 20% on the high street, down to 7%. At the same time as increasing our exposure to retail warehousing from really very little to 19% of the portfolio today. And retail warehousing is a sector that had performed very strongly last year, 16.5% growth in the values of our retail warehouse portfolio last year. And as I touched on earlier, we believe that rents have turned the corner. We've returned to, rental growth. So our asset management strategy is all about income, maintaining cash flow, enhancing value where we can. And our strategy is what I call close asset management. A lot of people talk about active asset management, but I would argue that active asset management is the minimum you should expect from an investment manager. But close asset management, sticking really close to our tenants, and we collect all our own rent, we manage our own properties, is really important. And that tenant engagement was never more valuable than when we went into COVID and rent became fundamentally optional for tenants to pay. But through that period, we managed to collect 91% of contractual rents. We gave away less than 3% of rent roll in concessions. And we now consider the rent collection as returned to normal. And those tenants with whom we did cut a deal, they have stood by their commitments, and we have collected the back rent that was due in almost every case. As a diversified fund, we can adjust asset allocations as one sector outperforms and one underperforms. And we can find those mispricing opportunities and move between the sectors to keep the portfolio current and keep it income producing and picking up the best rental growth opportunities. Of course, that is an option that is not open to the heavily themed property companies. They are stuck in their sectors. They don't have the opportunity to flex as much as we do. And all of this, as coming back to the same old point, allows us to generate that yield margin from smaller lots. I think this chart's useful just to demonstrate the amount of activity that has happened through the last 12 months. And this is effectively a rent bridge. It takes us on the left of the chart from about 38.7 million of income. You can see we made acquisitions, which increased the rent roll. We had disposals that decreased the rent roll, but we also had some rental growth and some new lettings to take the gross rent up to 40.5 million. And this is what we should be doing. We should be generating more income because, as Ed said at the start, we are a true REIT in that we want to generate income and distribute as much of that as we can through dividends to shareholders. But you can see from that, it's been an active year. Just some examples of recent asset management. A new letting of a logistics unit in Redditch, a new 10-year lease at a new higher rent, which saw a £3.5 million valuation increase, just demonstrates the sort of increases you can achieve when leases come to an end. You know, there's a lot of talk about the value in long leases, but for a portfolio with well-chosen properties, there's nothing like the opportunity of a lease expiry to reset the clock, increase the rent, refurbish if necessary, bring in environmental improvements to the buildings and drive values. And the second piece of asset management there just shows you that even from bad news comes good. And here was it's an example of a Tim Hortons coffee shop. We had 2 Pizza Hut restaurants, which we repossessed following their CVA. We had the opportunity to take back possession. And in so doing, we were able to move those from standalone restaurants to brand new drive-through restaurants, which we've let to Tim Hortons on 15-year leases. £2.3 million valuation increase to take the value of the 2 drive-throughs to 4.6 million. But that fundamentally came from a CVA, which would be seen by many as a bad thing. Ed touched on this again. We acquired Drum Income Plus REIT for 41.7 million, 20% discount to net asset value. That showed us a £7 million valuation uplift. And we sold some industrial units. Why, you might ask, when that seems to be what everyone wants to buy? The answer is when you've got a good selling market, you bring out those assets that you don't feel are a long-term fit. And we managed to get an excellent price on those because of the strength of that market. We sold some car showrooms, a retail warehouse to a special purchaser, and 5 smaller shops. And profit over valuation on that was another 9.5 million, all helping to drive the portfolio forwards. I'm going to pass back to Ed now, who will talk through our ESG strategy.
Thanks, Richard. ESG is now embedded in our property strategy, and that's demonstrated by the KPIs shown on the screen. At the top, you can see our commitment to reduce emissions and energy consumption, and that's going to require significant tenant engagement. We've recently implemented an online platform called Adapt to collate tenant data and interrogate it and try and help identify areas for improvement. And we have an aspiration to fully automate the data collection process, and we've begun a process of rolling out smart meters to all of our vacant buildings and those earmarked for refurbishment to try and achieve that. We'll talk more about EPCs on a subsequent slide. We're only choosing energy suppliers who offer 100% renewable tariffs, and we're investing in on-site renewables and in particular electric vehicle charging. You can see on the right hand side of the slide is an InstaVolt electric charger, which we put 16 of across some of our retail warehouse portfolio a few years ago. And the model has moved on since then. So we're now partnered with Pod Point, and we're actually owning the kit. So we own the asset, we install the asset. We are selling electricity to the public and making a profit on it. And the expected payback on those Pod Point chargers at the moment is around 4 to 5 years based on based on usage expectations, and we're going to continue to roll those out into our office and industrial portfolio as well. Where possible, we're incorporating sustainability clauses into leases, which oblige tenants to share data to allow us to install carbon reducing technology and other efficiency measures. We're setting targets also to be fully compliant with ESG legislation and best practice. So we've opened ourselves up to scrutiny by disclosing EPRA benchmarking and GRESB benchmarking, and also included selected elements of TCFD within our annual report. This slide shows the EPC, so Energy Performance Certificates, position of custodian REITs at the end of March 2022. You can see that the majority of units fall within categories B and C, and we've carried on our programme of re-rating assets where we believe there have been improvements. So a further 20 assets have been covered this year, and we've managed to get a small improvement in the average EPC score from 63 to 62, so well within the C category. And I think importantly to note is that since March 2020, all of the F and G rated properties in the portfolio have been improved to have none of those categories.
So just looking at that in real life, what does all this mean? Here's an example of a property before and after shot. So before, on the left, an industrial building in the West Midlands with an EPC of a C. That lease came to an end, and we took control of the building. We installed solar PV, electric car charging points. We removed all gas from the site and put in air source heat pumps to heat the offices and extended the yard. What did all of that mean? Well, it was a capital expenditure of 1.1 million. It improved the EPC from a C to a B, and we have let that building on a 10-year lease, pushing the valuation on by £2 million. So more than recovering the cost of improving the environmental credentials of the building. And I think this is a really important point, because I think it'd be very easy for people for shareholders to be worried that the cost of meeting the ESG targets that we're setting ourselves and are being set by the government is going to fall heavily on shareholders' shoulders. I think the truth is that with a well considered budget, it's possible to see real increases in value by bringing buildings up to spec. Not only is it just going to increase the valuation, it's going to minimize the letting period, because these buildings are going to be more in demand from occupiers who also have ESG targets to hit. And another example is a building in central Birmingham, and you can see on the left, looking a little bit grubby, EPC of an E, rents at the time £12.50 a square foot. We removed an oil-fired boiler. We replaced all the windows with new double-glazed units and installed electric comfort cooling in the offices, all individually controlled suite by suite. And as you can see in the photograph, we cleaned the exterior. So a much nicer looking building appeared from behind the scaffolding, and rents in that building increased immediately post refurbishment from £12.50 to £18 a square foot. And we've just agreed in the last month 2 lettings ahead of £19.25 a square foot, and driven the valuation on accordingly. So another example of where spending money on the building sees net valuation gains. So what's the outlook? Industrial logistics assets, we believe, still have rental growth. I think yields are topping out. But we feel that there has been less yield compression in the smaller lot size sector. And we believe there is more rental growth potential So we still think there is value in that sector. I mean, if we just look at passing rents versus our valuer's estimate of rental value, our industrial portfolio has an 18% reversion built in, but we think there's further growth from there. Retail warehousing rents should recover from 2021 levels, which was probably the bottom of the cycle. Maybe early 2022 was the bottom, but we see recovery. As a sector, it demonstrated extraordinary resilience through COVID. Most occupiers in those large format out-of-town stores continue to trade, and we've seen particular strength in DIY, homewares, and the discounters and food. Drive-through, we think, is a sector that will see good growth. There are many more operators trying to get into the drive-through sector than there are drive-through locations at the moment. So we will either see further development or competition for sites, or indeed both, and that I think will lead to rental growth. Offices have been an interesting one to call, but our firm view is that city centres will be robust, particularly in prime regional city centres. And if you look in a lot of regional office centres, the city centre rents are sometimes nearly double the out-of-town business park rents. And I think that is telling you what occupiers think about the relative merits of being city centre versus business park. So we think that there is still life in that office market. And we have recently agreed terms to buy on the high street, but only the very best, most prime of locations are meeting our requirements at the moment, because we do see a return to growth in some high street locations. And let's not forget, we are growing from a very low base, and that is a sector that was hit incredibly hard. But one of the advantages of a diversified fund is that we can take those opportunistic judgments when we need to. And finally, and I've touched on this already, in an increasingly theme-led world, don't overlook the benefits of diversifying risk and targeting sustainable income from well-let real estate. And when we consider sustainable income, I think a metric that is massively underrepresented in all analysts' analysis of the sector is earnings, and even the earnings yield. And if you take Custodian REIT's earning yield, 5.9 pence of earnings against the share price today, gives you an earnings yield of 5.84%. And that's against an average across our close peer group, so the other diversified funds, of closer to 4%. That tells you an awful lot about Custodian REIT's ability to pay dividends, and it's dividends that support 70 to 80% of total return over the long term. Thank you very much.